Okay, today's screen video has to do primarily with the statement of cash flows. It's one of the so-called primary financial statements. So when a company issues financials, this must be included. In my view, the most important one. So what does it tell you? It tells you, skip down to the final Jeopardy answer, it tells you how you went from the beginning of period cash to the end of period cash. What happened? And it's not a narrative like once upon a time we had a lot of money, now we have none. This is a computation. So we have three different types of cash flows. They can be positive, they can be negative in total. The first category, cash flow from operating activities. This would be the mainstream activity of the company. This is their bread and butter. You're hoping that this is a positive number because this is basically what your company is all about. And this is the kind of cash flow which is is going to repeat over and over again from one year to the next. So where do we start? Well, we start from net income or net loss. That's our starting point. And of course, net income or net loss is going to include revenues and expenses, which are obviously related to operating activities. Unfortunately, we can't just use that number because it requires a great deal of modification. So I have the modifications broken down into three areas. First of all, on the income statement, we're going to find that there are expenses that don't require the use of cash, and there may actually be income that doesn't result in the collection of cash. For this class, we're going to concern ourselves with these two over here. Okay, if this was intermediate accounting 2, we'd be looking at a lot of other things. But why would we add back depreciation? Why would we do that? Well, net income includes the depreciation expense. It was reduced by depreciation expense, but there's no credit to cash. So that is a cashless entry. So we add that back. In other words, you're saying, well, what would my net income be if I didn't have depreciation expense? Same thing for amortization of intangibles, and in this example, I have patents. Typically in the textbook scenarios, rather than crediting an account called accumulated amortization, which you could have on your chart of accounts, you're going to find that patents or the asset account is credited directly, and that's going to come into play later when we try to figure out what happened with our patents. So for this first area, the so-called non-cash items, we're going to add back depreciation and amortization because there's no use of cash in either one of those transaction entries. All right, then we have non-operating gains and losses. So gains and losses, you say, well, of course those would be on the income statement, but we're going to take them out of this section. What section? Operating section. Take them out because, not because they don't have cash implications, but because the implications belong in a different category. And these are the different categories. All right. So if you have a gain or a loss on the sale of a plant asset, well, that's going to come into play in your calculation of the proceeds from the sale of a plant asset. So what we're going to do here is we're going to add back the losses or deduct the gains. Why would we add back the losses? We want the net income exclusive of the loss or gain. So that's the rationale. The same thing for the gain or loss on the sale of an intangible asset or on an investment. Okay, same logic. Add back the losses, deduct the gains. Now we're going to deal with these when we get to the other categories, those categories being investing and financing. All right, so same thing for a gain or loss on the retirement of bonds. Add back the losses, deduct the gains. And you're going to find the proceeds from a bond issue rather, or the cash used to retire bonds in the financing section. All right, so we're going to pull those out, add the losses, deduct the gains. And the last adjustment that we have to make to our net income is to convert from the accrual to cash basis, which is pretty easy to do. Not the easiest thing in the world to explain. So what I have over here is a little example. So let's say we started the year with $100,000 in accounts receivable, which is a current asset, which is related to operating activities. And then during the year, we had sales of $1.1 million. So here's my little textbook entry, right? To record the sales for the entire year. At the end of the year, we got $150,000 in accounts receivable. So what's the chances of beginning and ending the year with the same exact accounts receivable? Answer is 0, of course. So what happened over here to make our balance 150? Well, that number must have been, I'm not sure if my formula's updated. Nope, not. Must have been 1050. So we added this, and we subtract this, which is the collections, which would give us the balance of 150. So what happened here? Well, look at it this way. If your accounts receivable goes up, what does that mean? That means you collected less than you billed. If your accounts receivable goes down, that means you collected more than you billed. And that's what you're hoping for if you're the corporation, because you don't want to have a lot of accounts receivable. And that's what happened here. So the receivables went up because the collections were less than the billing. So fortunately, the logic here pertains to all current assets that relate to operating activities. And this is what we're going to do. So if you have an increase in a current asset related to operating activities, you're going to deduct the increase. So I always tell students, the way to remember this is the opposite direction for a current asset. So if accounts receivable goes up, what do? You deduct. If accounts receivable goes down, what do? You add. And the same thing is true of what? Of inventory, prepaid supplies, any other current assets related to operating activities, which would not include short-term investments, even though they are current assets. All right, now for liabilities, got another little T-account deal going on here. So let's say that we had interest payable that went from $20,000 to $30,000 from beginning to end of year. And on the income statement, we find a number, and the number is, let's say, $120,000. So every month there's an accrual of interest, and it adds up to $120,000. That's the payable. All right. So if that's the case, then how did the balance get to be $30,000 at the end of the year? So the answer is that this number here must be $110,000. And that's the cash number. That's the number we're looking for. Okay. All right, so let's see. What is this telling us? It's telling us that if you have a liability related to operating activities like accounts payable, or interest payable, or salaries payable, or accrued expenses payable, if you have such a liability and it goes up, the bad news is you owe more money, and the good news is what? You paid out less money. So if a liability account goes up, what do you do to adjust to the cash from 120 to 110? You add it. So we want to go in the same direction of the change here. And there we have it. Okay, so there's our adjustments. And you can kind of paint by the numbers. Current assets go in the opposite direction of the change. And what are we talking about the change? The change is the difference between the beginning and end of period balance. Same thing here. If liabilities go up, what do? You add, same direction. goes down. What do? You deduct. Okay, now we have all that, and I have a list of operating related current assets and liabilities over here. As I mentioned earlier, investments or short-term investments, even though they're current assets, you're not going to include. Why? Because that would be an investing activity, which is coming up, and dividends payable is current liability. You're not going to include that. Why? Because dividends is a financing activity. So we do this whole routine, and we add everything up. And when we do that, we wind up with our cash flows from operating activities. And again, we're hoping this is a positive number because this is the most important cash flow category for our company. All right, now hoping that that's a positive number. What could happen? What else could happen? Well, we could have investing activities. Now, when you think investing, like investing in what? Like Apple stock? Yeah, that could be it. That could be one of these. Yeah. Trading securities are available for sale securities. You could have bought bonds. Yeah, that'd be an investing activity. But also, if you buy or sell property, plant, and equipment or intangible assets, that's also considered to be an investing activity. All right. So investing includes things that you might not normally think of as investing. In other words, property, plant, equipment, intangible assets being bought or sold. Okay, so we have to figure out the proceeds from the sale if there is one. Now, if you go and you buy trading securities, okay, that's pretty simple. That's just outgoing cash. So if I paid $100,000 for Apple stock, I'm going to have a negative $100,000 in this category. If I sell stock, well, then you have to keep in mind that, and what's the chances of you selling an investment for exactly what you paid? And the answer is almost nil, right? So you have to take into account any gain or loss. So if you sold your Apple stock at $5,000 gain, well, it cost you $100,000, but you sold it for $5,000 more. This would be a plus 105 over here. And we're going to look at a numerical example in a little while. Same thing for available for sale and held to mature. I don't think we have these in your problem, but that's what you would do. Property, plant, equipment. Okay, you buy property, plant, equipment using cash. Well, that's just a straight negative. Same thing for intangible assets like patents. It's a little bit more complicated because if you sell, you don't use the original cost to calculate the cash incoming. You use the book value. In other words, the original cost minus accumulated depreciation. So, okay, so once you calculate the book value, you're going to add a gain or subtract a loss to get to your cash flow for property, plant, equipment. For intangible assets like patents, you're going to take the cost of the intangible asset, the amortized cost, and you're going to add a gain or subtract the loss to get your cash flow. So that's what this category is. Now, in real life, in practice, if this comes out to be a negative number, that's not necessarily a bad thing because hopefully you're taking your positive operating cash flow and you're plowing back the earnings into investing activities to benefit the future of the company. Plant the seeds for income down the road. All right, so that's the second category, investing. The third category is financing, which primarily has to do with your long-term debt and stockholders' equity. So what could happen in here? Well, if you issued bonds or notes long-term, then you got incoming cash over here. If you retired bonds, you're going to have a gain or a loss. Most of the times it would be a loss. So if you retired bonds that had a face value, I'll say carrying value, of $100,000, and you retired them at a $5,000 loss, what does that mean? That means that you had to pay more than $100,000 to retire the bonds. So you would add a loss in calculating the amount of money required to pay off the bonds. A stock issue, well, if you issue stock for cash, you're going to have an increase in the stock account, you're going to have an increase in the paid-in capital account, and then you're going to have an increase in cash as a result. So that gets added over here. If you go out and you buy your own stock on the open market, that's treasury stock. That's going to be a negative number. Okay. If you reissue treasury stock, that's going to be incoming, and that could get really complicated if you were in ACC 202, which we're not. So proceeds from treasury stock, we're going to assume that we sold the treasury shares at cost, which makes it easy. Dividends. Okay, dividends. Okay, they're going to be a reduction in retained earnings, and we're going to have to look at our dividends payable account when we figure this out. So let's go back to your liabilities, right? If a liability goes up, like dividends payable, what does that mean? That means you paid out in the way of dividends less than you declared, okay? That's how that works. If the liability goes up, that means less cash was paid out. If the liability goes down, it means more cash was paid out. So we get the totals for the three categories, and we got to look at a numerical example, right? And we get a total of the three, A, B, and C, operating, investing, financing. We get an increase or decrease in cash, which hopefully reconciles the beginning of period cash to the end of period cash. So before you even do one of these kind of problems, you know what the final Jeopardy answer is. You know what this number is. So speaking of the final Jeopardy answer, let's go to Melicanor. This is Melicanor's Mangiata Magnifico. And we have the balance sheets from 16 and 17. And here's the final Jeopardy answer. You started with $2,000 in cash, and you ended with $52,000. So we were looking for an increase of $50,000. That should be the number that we come up with when we add the three categories together. All right, so let's go and see what the story is. Let's do the first section. Again, you could kind of paint by the numbers. Let's see if we can pull this all in here a little bit. Maybe a little bit more. Okay. So what do we want to do? We want to add back the non-cash. So that would be these guys over here. And there could be more if we were in intermediate 2, but for this class, we're going to add back depreciation. Where are we going to find that? We're going to find it on the income statement on one of those rows that I made too small. And what is the number? The number is 14.8. We're going to add that back. Didn't require the use of cash. We're also going to add back the amortization of 6,000. So let's go back up here. Add those two numbers in. Okay. Then we have non-operating gains and losses. So you're going to deduct the gains and add the losses. Where are we going to find these gains and losses? We're going to find them on the income statement. So what do we have? We have two gains, one on investments and one on patents. And then we have one loss. I should have pulled the plug on that, right? When we have one loss of $3,000 on the sale of equipment. So what do? We want to get these out. What would our net income be if we didn't have those two gains? It would be less, right? So we subtract those. What would our net income be if we didn't have this loss? It would be more. So we're going to add it back. All right, so let's go back up here. Gain on sale of investments, which was what, 25,000. Take it out. Gain on sale of patents, I believe that was 18,000. And loss on sale of equipment, we're going to add back, and that was 3,000. Those are your non-operating gains and losses. All right, now this section here, what are we going to do? Current assets, we're going to go in the opposite direction of the change. And current liabilities are going to go in the same direction of the change. So let's see, what do we got? Let me try and get this all in here. Okay, what happened with accounts receivable? Went from 68 to 84. So that's an increase of 16,000. That's our money out on the street. We didn't collect it. So increase, what do? Minus 16,000. Okay. What happened? Inventory goes from 72 to 65. That's a decrease of $7,000. Add it back. Prepaids. What happened? It goes from 5 to 24. That's an increase of 19. Prepays. If we had supplies, we would factor that in as well. We don't have supplies. Okay. So there's our current assets. These we went what? In the opposite direction of the change. Now we're going to do the current liabilities. We're going to go in the same direction of the change. So accounts payable, operating related, goes from 112 to 68.2, which is what? 43.8. And that's a decrease. And the good news is you owe less money, and the bad news is, guess what? You had to pay out cash to make that happen. So minus 43.8, same direction. Salaries payable plus 3,000. Accrued expenses payable minus 8,000. And income taxes payable, which is considered operating in this context, minus 7,500. Okay. Then we get a total for this category, which is the conversion from accrual to cash basis. We got a big $7,500, so our operating cash flows are not exactly good. Excuse me. So now, investing activities. Proceeds from sale of investment. So a lot of these problems we have to do a little detective work. So let's see what the story is with investments. We had investments that went from 62,000 to 50,000. So clearly something was sold because the balance went down. But how do we know there wasn't something bought as well? Well, we don't. So in the real world, you'd have a year-to-date general ledger and you could see exactly what happened in here. So let's go down here and see what the other information is. It says a panini machine costing $11,000 was acquired with cash. And it says an investments costing $18,000 were purchased with cash. So all this stuff here is going to involve investing activities in this area here. All right, so we're on investments, right? So do a little T account. Now this is not an accounting class and we don't need to do debits and credits, but what we're trying to figure out is what happened. So if we started with 62 and then we bought an investment costing 18,000, that would have brought us to balance up to 80,000, but we didn't end up at 80,000, we ended up at 50,000. So we must have sold something that cost $30,000. And what's the chances of us selling something that cost $30,000 for exactly $30,000? The answer is almost nil. So we're going to have to adjust this number here. All right, let's see. Now, 18,000, that's pretty straightforward. That's going to be what? I got the captions already, so you don't have to watch my horrible typing. Paid to acquire investments. And that was what? Minus 18,000. Proceeds from sale of investment. So we got to go with the cost, 30,000. And then say, well, all right, was there a gain or loss on that transaction? That goes back to our income statement number. We had a gain on sale of investments of 25,000. So we're going to add that in here. So what's the total proceeds? It's the $30,000 cost plus the $25,000 gain, which is $55,000. All right. Now let's move on to equipment. That's going to be that panini machine. The panini machine we acquired with cash, so that's straight outgoing cash of $11,000. And it looks like we sold equipment at an original cost of $12,000 and accumulated depreciation of $3,500. All right, so the $11,000 is the easy part. So let's put that up here. Paid to acquire machinery or equipment. All right, 11,000, straight outgoing. This is a little bit more complicated than the investments because we have to calculate the book value of the equipment. What is the book value? Book value, excuse me, of any asset is the original cost minus the accumulated depreciation. So that's looking like what? $8,500 as a book value. All right, so let's go over there, drop that in. That's the book value, original cost minus accumulated depreciation, plus or minus gain or loss. And the answer here is what? There was a loss of $3,000. So we sold something at a book value of $8,500, but we took a $3,000 haircut. So what does that mean? That means we only collected $5,500. Okay. Next on the hit parade, proceeds from the sale of patents. Let's see what we know about patents down here. So these patents were sold on 12/31/17. Okay. All right, so we look at the account and we see that we went from 25 to 0. So at first glance you might think, well, we must have sold patents that cost 25,000. But that goes back to what? Something I mentioned earlier, right? This one right here. When there's amortization of patents, the credit goes directly to the asset account. So we know that in the example we're now looking at, Melicanor, patents had been reduced by the amount of amortization that was on the income statement. Okay, so what amortization do we have on the income statement? We had $6,000. All right, so now I'm going to do a little T account down here. Here's our patents. Started at 25. In the income statement, we know that was reduced by 6. That brought us down to 19, but we didn't end up at 19. We ended up at 0. So we sold patents that had an amortized cost of $19,000. Did we sell them for exactly $19,000? You say no. That would take all the fun out of the problem, right? So we're going to take that $19,000 cost, which we had to do a little detective work to find. And add gain or deduct loss. And in this case, that's going to be add, I believe that's $18,000. Gain. We sold, amortized cost of 19, sold at an $18,000 gain, so the total amount is what? $37,000 incoming. And there's the total for the category. 68.5. Okay. Next on the hit parade, financing activities. All right. So we'll look at our long-term debt and stockholders' equity, see what we can figure out. Bonds payable goes from 15 to 25. So this is a rare problem when we're actually issuing bonds. So we issued $10,000 worth of bonds. And what did we get in return? We got cash. So that's going to be a plus 10 proceeds from bond issue over here. Stock issue, okay? How do we know what that is? It's going to be mentioned down here, right? Stock was issued in exchange for cash, but how much? Okay, so we have to look at the two accounts involved. What are the two accounts? The two accounts are common stock, which goes up by 2,000, and paid in capital, which goes up by 9,000. So accounting wise, those would be credits, but we're concerned with the cash number, right? So we must have issued the stock for $11,000. Increase those two accounts. That's pretty easy to figure out. So that's going to be a plus 11. Treasury shares. Well, we reissued Treasury shares as mentioned in letter C at cost. It makes it pretty straightforward. So the account balance went from 36 to 28. So that's a decrease of 8,000. So accounting wise, that's going to be a debit to cash and a credit to treasury stock. Now treasury stock has a debit balance. So when you credit a treasury stock, it goes down. So forgetting about the debits and credits, this account balance goes down. What does that mean? It was cash coming in. Proceeds from reissue, 8,000. Which brings us to the last number that we need, which is dividends paid. So, let's see. I think I got a little dividends payable down here somewhere. There it is. So when you declare dividends, you make this entry. And we don't need to know the debits or credits, but you do need to know is that when you declare a dividend, that your dividends payable is going to go up. Now, how do we know it's 70,000? Got to expand this. It's a given. So our dividends declared are 70. That would have done what? That would have increased dividends payable, which started with a balance of 0. We ended with a balance of 15,000. What does that mean? That means we paid out less money than we declared. 55,000 is the final Jeopardy answer. We declared 70, we paid 55. Our balance went up to 15K. What number do we want to show? This is the number we want to show. So the short story is what? If dividends payable goes up, it means you paid out less than you declared. If dividends payable goes down, it means you paid out more than you declared. So we are in the less than you declared area. And it looks like I might have actually done this correctly. All right. You add the three categories together, the 7,500, 68,500, and the 26,000. And you're hoping against hope that what? That when you do that, that it comes up to $50,000 increase in cash. Because that was the number we knew right off the bat. We were looking for a plus 50 and we found a plus 50. And that's a good thing, right? As Martha Stewart would say. And then we reconcile to the ending balance down here. And there you have it. Okay? Statement of cash flows. We love this one because this is the hardest one to cheat with. I mentioned cheating because if you looked at all the videos and things that I sent to you, and you realize that there's a great deal of cheating going on. So there we have it. Now, there is one other thing I want to mention. I mentioned it briefly earlier, but this one, Tatiana, which you're going to try and do on your own, Tatiana's Tortellini, bonds are paid down. That means money went out for the bonds. And it also means there would have been a gain or a loss. There's a loss. Okay, so that's the key information to figure out, well, how much did it actually cost to pay off these bonds? There you have it. Okay, Melikanor, Illustrative, and Tatiana. All right, now a little other administrative activity. This was edited. Apparently, the version of this that went out failed to include a final correction, shall I say, or change. So anyway, your income tax allocable to income from operations on Grift and Grab should be $235,000. And just to show you that I'm not as bad as everybody says I am, I put together a little income statement here. The final Jeopardy answer is $100,000. Now we still need the statement of retained earnings, and we need the balance sheet for this one. And that, I believe, we will go over in a next totally amazing screen video. In addition, we'll do a little bit of financial ratios, which is always a fun thing. So for the financial ratios, we're going to take the reported numbers and we're going to manipulate them with formulas and whatnot to try to gain additional insight into how well or poorly the company is doing. There you have it. So give Tatiana a shot, see how you make out. Ask as many questions as you like. There is no extra charge. There is no limit on the number of questions you can pose. All right, until next time.